On Monday, U.S. stocks opened with a sharp surge but quickly pulled back exactly as I anticipated earlier in the day. So why was I expecting this pop and fade move after Friday's big rally? Let me walk you through my reasoning, looking back at Friday's market reaction. It was clear that investors had already priced in a September rate cut from the Federal Reserve. At this point, that cut is almost seen as a done deal. If it happens, it would mark the Fed's first cut since last December, following a 9-month pause in policy changes. That naturally raises the key question: when the Fed pauses for an extended period and then resumes cutting rates, what typically happens to the stock market? I know many of you have been curious about this, so I dug into the historical data going back to 1970, and the results are worth your attention. But before we dive into the numbers, a quick introduction. Hi everyone, I'm Eve, an investor focused on the US markets. On this channel, I share clear, data-driven analysis without the hype or noise. If you're new here, make sure to hit subscribe. And if you find value in this content, a quick like really helps support the channel. In my morning note today, I specifically warned that we'd likely see a pop and fade pattern, a strong open followed by weakness, and I stressed, do not chase strength. If you're looking to buy, wait for the pullback. I also flagged 2 key areas to watch: Chinese ADRs and, of course, NVIDIA as we head into its earnings release. So, back to the central question: if the Fed does cut rates in September, how might the market actually react? Here's what the data shows. Since 1970, there have been 11 instances where the Fed paused its rate-cutting cycle for 5 to 12 months and then resumed. In those cases, the S&P 500 didn't perform particularly well in the near term, falling about 0.9% in the first month and about 1.3% 3 months later. Not exactly the immediate bullish response some investors might be hoping for, but zoom out and the picture changes dramatically. Over the following year, the S&P 500 finished higher in 10 out of those 11 instances, with an average gain of 12.9%. The takeaway is pretty clear: if the Fed cuts in September, there's a high probability of a short-term sell-the-news reaction, especially in that 1 to 3 month window. But over the medium to long term, equities still carry a strong likelihood of trending higher. In other words, expect turbulence in the short run. But don't lose sight of the bigger bullish picture. As I mentioned over the weekend, mid-September could mark a key turning point for the market. And history suggests that any pullback that follows could present a strong buying opportunity. Once the easing cycle begins, the odds overwhelmingly favor higher stock prices over time. That said, the biggest near-term risk is exactly this: the market selling off right after the announcement. With about 3 weeks left until the Fed meeting, investor sentiment is still elevated. The indexes could continue to grind higher, maybe even test fresh all-time highs, but don't get carried away. Think about Friday. If investors were truly euphoric, the rally would have been stronger. Yes, all 3 indexes gained, but none advanced more than 2%. That shows a layer of caution is still present beneath the surface. Now, why was I confident about Monday's pop and fade call? The answer lies in crypto. On Friday, Ethereum surged right after Powell's remarks, mirroring the equity rally. But over the weekend, the rally stalled. Instead of building momentum, prices went sideways. In a truly strong market, we should have seen another leg higher after 2 full days of consolidation. Instead, by the US night session, both Ethereum and Bitcoin were sliding sharply. To me, that was a very clear signal that equities were unlikely to sustain Monday's rally. A spike and then fade was the higher probability outcome. This is an important lesson. When US equity markets are closed, crypto often acts as a sentiment proxy. It gives you an early read on what Wall Street might do the next trading day. That's why in today's playbook, I avoided chasing any crypto-related longs. Instead, my focus remained on Chinese ADRs and NVIDIA ahead of its earnings report. So here's the question I'll leave you with: is this setup a golden opportunity for patient investors, or just another trap carefully set by big capital? Share your thoughts in the comments below. I'd love to hear your take. And don't forget, hit like and subscribe so you don't miss my next video, where I'll be sharing even more data-driven insights that could help you navigate what is shaping up to be a very volatile fall for the markets. In today's video, I'll continue to share my strategies on Chinese ADRs as well as NVIDIA, but before diving into ADRs, let's take a step back and review the recent performance of China's shares. What you're looking at here is the Shanghai Composite Index. The chart clearly shows that shares have been trending very strongly, and overall the momentum looks both steady and healthy. So why do I say the trend looks healthy? Let's rewind for a moment. If you remember last September, shares also staged a powerful rally. But that rally was sharp, overheated, and unsustainable. It quickly triggered regulatory pushback. This time, however, the rebound is unfolding much more gradually, with prices advancing step by step along the 5-day moving average. In my view, this type of 2 steps forward, 1 step back progress is much more constructive. When stocks climb at a measured pace, the risk of abrupt regulatory intervention is significantly lower. With this backdrop, Chinese ADRs are worth serious attention in the coming weeks, but here's the golden rule: don't chase strength. If you see a stock already surging in pre-market or intraday trading, jumping in at those levels often leaves you stuck at the top with little room to profit. Take Futu Holdings, Up Fintech, and NEO as examples, names I've highlighted in previous videos and notes. The smarter play is to watch for these stocks to pull back toward technical support levels, such as the 5-day moving average or open gaps, and look for entry opportunities there. Judging by today's action, Futu appears the most stable of the group. That said, other ADRs are also worth tracking, but keep in mind, several companies are heading into earnings, which can introduce extra volatility. For instance, Pinduoduo reported earnings today that beat expectations, yet the stock still swung wildly pre-market, with intraday volatility large enough to cause double-digit losses if you mistimed it. Similarly, Alibaba is scheduled to report before the open on the 29th, and Up Fintech reports on the 27th. Whether Alibaba delivers a beat remains to be seen. But based on current trends, I believe Up Fintech has a high probability of posting solid numbers. Of course, if earnings-related risks make you uneasy, or if you want to avoid a repeat of Pinduoduo's roller coaster, you can always sit on the sidelines. But in my view, buying ADRs on pullbacks during this stretch still offers relatively high conviction compared to chasing breakouts. Now let's shift gears to NVIDIA. Last Friday presented an excellent buying opportunity. If you missed that move, then today your best approach was to stay patient and only consider entering on a dip. Remember, in a choppy market, if a stock has already surged one day, the next day usually doesn't offer the best setup for a new entry. The short-term upside is limited, and chasing into strength increases the risk of getting trapped at a high. We saw this dynamic play out broadly in today's market. Traders who bought on Friday are sitting on gains, while those who chased into the bounce today are more likely holding losses. Looking specifically at NVIDIA, earnings are set to be released after the bell on the 27th. Since today is the 25th, that leaves just 2 trading sessions before the report. There's still a bit of room to position for a move. But the closer we get to earnings, the trickier it becomes to trade effectively. In today's newsletter, I highlighted $176 as a key support level for NVIDIA. If intraday the stock dips toward $171 and holds that level, that could be a compelling entry point if you manage to buy the dip this morning. Then the playbook over the next 2 days is to consider trimming into strength, of course, if you want to hold through earnings. That's also an option, but don't forget what happened with Pinduoduo today. NVIDIA could just as easily stage a similar roller coaster on its earnings release. From Friday's rally through today's action, the market had the entire weekend to digest gains, and short-term money has behaved fairly rationally. That's why U.S. equities didn't extend higher in a straight line today. It suggests that for now the indices are likely to remain range-bound at elevated levels rather than entering a new leg higher immediately. Looking forward, there are 2 key catalysts that could drive U.S. stocks in the near term. 1, whether NVIDIA's earnings surprise to the upside. 2, whether the Fed delivers a rate cut in September that exceeds market expectations. That's why my short-term recommendation remains the same. Approach this market with a consolidation mindset. Don't get overly optimistic at current levels. The boost from Powell's dovish tone will gradually fade, and sentiment may stall or even reverse. In particular, once the September Fed meeting is behind us. That could mark a critical window where markets shift direction. That wraps up today's discussion. If you have questions, feel free to leave them in the comments. I'll continue sharing detailed pre-market strategies tomorrow, so be sure not to miss that update. Thanks for tuning in, and we'll pick this conversation back up after tomorrow's close.